Here we're going to work a series of problems. I've included BE8-8 because our next problem, we already worked that in a previous video, but our next problem, BE8-10, is going to depend on it. And then we'll move on to a couple other separate problems. BE8-10 says refer to the situation in BE8-8 and assuming income tax rate of 25%. What is the LIFO liquidation profit or loss that the company would report in disclosure note accompanying its financial statement? Let's remind ourselves what BE8-8 says. It says Esquire Inc. uses LIFO method to report its inventory. Inventory at January 1st, 2021 was 500,000, and this was for 20,000 units at $25 a piece. During 2021, 80,000 units were purchased at all of the same price of $30 a unit, and then 85,000 units were sold during 2021. So what we're asked to do for BE8-10 is assume a tax rate of 25% and then calculate what the LIFO liquidation profit or loss is going to be. All right, so in order to do this, we're going to take into consideration the units that were actually liquidated. It tells us that 85,000 units were sold, 80,000 units were purchased. So the difference that we have is 5,000 units were sold above what was purchased during the year. So 5,000 units represents the units that were liquidated. We're going to multiply that by the difference between the beginning inventory price and the purchase price during the year. So this difference of 30 minus the 25 is going to be 5. This represents the liquidation prior to tax. And then we'll multiply this by 1 minus the tax rate. So 1 minus 0.25. provides for us 0.75 that we'll multiply by, and this gives us 18,750. This represents our LIFO liquidation profit. And it's a profit because notice that this right here, this 5,000 is going to be at a cost of $25 when the actual current costs are $30. So essentially what we're getting is a reduction in cost of goods sold because we're dipping into a prior layer. And so what that does is produce a higher profit because cost of goods sold goes down. And so that's where we get the 18,750 as the LIFO liquidation profit. Let's now go on to the next problem. This problem states King Supply maintains its internal inventory records using perpetual FIFO, but for financial reporting purposes, it reports ending inventory and cost of goods sold at periodic LIFO. At the beginning of the year, the company had a balance of $60,000 in its LIFO reserve account. By the end of the year, the internal records revealed that FIFO ending inventory is $75,000 greater than LIFO ending inventory. It wants us to record the year-end adjusting journal entry for the LIFO reserve. So currently right now, the LIFO reserve has a balance in it of $60,000. That's to account for where it's at. Currently, it says at the beginning of the year has that balance. And we know that LIFO reserve is a contra asset account, so it's going to have a normal credit balance. They tell us that FIFO's ending inventory is 75,000 greater than LIFO ending inventory at the beginning, meaning that we have to reduce where we're at for FIFO by 75,000 to get to what ending LIFO should be, meaning that the LIFO reserve should be 75,000 credit as a contra asset account to reduce the LIFO ending inventory to its year-end or ending amount. And so the difference between here, that 15,000 represents what our adjustment's going to be. We notice that we're crediting, to get that credit balance, we're crediting LIFO reserve of 15,000. The other side of that journal entry is going to be cost of goods sold, and that's 15,000 as well. Remember, cost of goods available for sale only has one of two places it can go. It either goes into cost of goods sold because the goods were sold, or it goes into the ending inventory amount. We're adjusting ending inventory for LIFO here, which means the other side of our adjustment has to be cost of goods sold. The last problem that we'll work here says at the beginning of 2021, a company adopts dollar value LIFO for one of its inventory pools. It says the pool's value on that date was 1.4 million. The 2021 ending inventory value at year-end cost was 1.664, and the year-end cost index was 1.04. Calculate the ending inventory value at 2021 using dollar value LIFO method. Okay, so notice this is our base year. Our base year is 1.4 million, so its cost index at that point was 1.0. what we have to do is calculate what the change in inventory quantity is based upon the year-end cost of 1.664 and take into consideration the new cost index for the end of that first year. So our first step is going to be to deflate the 1.664 to base year prices. To do that, we take 1.664 and divide by the cost index of 1.04. This produces for us 1.6 million. Now we're going to compare back. So we had a base year amount of 1.4 million. We can see we go up 200,000. So we have 1.4 million at the base year cost or index. We're going to add to this 200,000. And this produces for us 1.6 million here, which is the amount that we just calculated for a year-end balance. And we'll multiply this by 1.04. This is for the new cost index here. Notice that this 200,000 simply represents the increase in quantity. And the reason why we couldn't just take 1.664 and subtract out 1.4 right here is because that would include an inflation in change in value, not just an increase in quantity. And the goal that we're trying to get is the increase in quantity, not just the increase in not just the increase in dollar overall, which would include inflation. So we have 200,000 multiplied by 1.04. This gives us 208,000. And the reason why we multiply this by 1.04 again is because now that we've isolated the increase in quantity, we do want to change that to current period prices. Remember, this is still LIFO. So we do want current period prices, but we don't want to include the inflation piece for calculating the change in inventory. So this gives us a total of 1,608. And this represents our ending inventory amount using dollar value LIFO.